Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Scott Kirshner, and Chaz Price. 419-794-3030 is the phone number. 419-794-3030, the website arhq.com. A central question when it comes to tax planning is whether someone will pay higher rates now or in the future when they really need the money. After all, the tax cuts passed in 2017, the quote-unquote Trump tax cuts, due to expire in 2026, which is getting closer and closer, guys. So what kind of retirement tax strategies in 2023 are you telling folks about?
Well, I think there's some great retirement tax strategies in 2023 that people really, can still take advantage of. Number one, I think about implementing the tax law, the changes that just happened in December of 2022. So a lot of folks are not familiar in the fact that the Secure Act 2.0 was already passed. You can check our YouTube channel. So if you go to America's Retirement Headquarters on YouTube, we have a video that talks, about the law changes within the Secure Act 2.0. We're going to be diving a little bit deeper into it as well at our upcoming event. We've got a couple of events that are coming up. If you go to arhq.com, click on the events tab. In the retirement playbook, we will be discussing some of those changes and how to apply them. But it's things like there's more changes to required minimum distribution. There's also higher contribution limits. So for those folks that are looking to either delay or get more money, making sure that you apply those laws to your situation. I think it was the Honorable Learned Hand that said there's two systems of taxation, one for the informed and one for the uninformed. And, it's this time of year, I think that taxes become an important topic because everybody's getting ready and or filing their taxes now. But, what they're doing is they're looking at recording history. And I think there's great accountants, there's great CPAs that are out there. There's a lot of people that we run into that do their own taxes on their computer. But the reality is that's just recording what happened in the past. What we're talking about when we're looking at, retirement tax strategies for 2023 is we're talking about what do you do this year to minimize the taxes that you pay now and also in the future. Now, Chaz, we had a meeting last week and we were meeting with these folks and Rick and Stephanie, and we were talking a little bit about their particular situation. They'd done a great job, had built up a nice nest egg for retirement, just kind of transitioning into retirement and talking about looking at their distribution plan. And part of the discussion was talking about, how do you keep the government away from their money? The thing is if you look at it, folks' retirement account or their house is their biggest or second biggest asset that they own.
Right.
A lot of people have saved in these traditional tax-deferred retirement accounts like 401ks and IRAs, and they build a nice nest egg. They, were avid savers, kind of like Rick and Stephanie were. The reality is they maybe hadn't addressed the issue of taking a look at, is it better to pay some taxes now, or should we wait until later to pay the taxes? And, as Chris, you pointed out in the beginning, some of the law changes are set to expire in 2026. It may make sense. And, if somebody just got together with their accountant, one of the things that you were looking at when you were helping them create their 2023 tax roadmap is we were looking at what I would refer to as strategic Roth conversions.
Yeah.
And, why don't you explain a little bit about what strategic Roth conversions are, and then, how is that different from like a tactical Roth conversion?
Yeah, that's a good question. And I think one of the main points that we bring up in that tax roadmap strategy is that it's one of the few areas that you can control in your financial future and in your finances in general is when and I guess if you pay taxes in some situations. And so, yeah, taxes are a big concern and a big topic of discussion. And, with respect to the Roth IRA conversions, that's one of the main ways that we can help you, mitigate some of the taxes, at least pay them now. It's kind of like when things are on sale. I use this analogy kind of leading into the conversation about Roth conversions and that, you go to the grocery store and when something's on sale, three things. What the price was before the sale, what it is now, and how long it's going to last. And so with taxes, particularly on your retirement accounts, they're on sale. We have some of the lowest tax rates that we've seen since the 1950s. And just given the state of our debt in the United States, it's a good bet that taxes are probably going to go up. So from a Roth conversion standpoint, what we're saying is that we're going to take advantage of the sale. on some of our retirement assets. Tax deferred assets like your 401k and your IRAs where we haven't paid tax yet. We're going to take a portion. We're going to, do some research, work with your accountant and your CPA and determine what amount would be appropriate to take out. And so strategically, sometimes that we're focusing on the long-term aspect. What sort of terminal value are we going to have left over? What's going to be the benefit of doing this longer term? And so in Rick and Stephanie's case, when we looked at it, because they were kind of starting that conversion a little later in life, they were already at 67. Rick was approaching 69. So when you start later in life, you have to take into consideration the fact that you're going to pay some taxes up front. We have to live long enough to get back in growth on our Roth IRA what we paid in taxes. And so when we looked at the analysis strategically, meaning long term, it actually didn't benefit them as much as opposed to a person maybe that started earlier in life, maybe at 60, so that by the time they had reached 73, which the current required minimum distribution beginning date is, that they'd be in a tax-free situation. To your point, Nolan, there is also a tactical component to Roth conversions. Tactical meaning kind of the short-term movements that we're taking and actions that we're taking to get us to the long-term goal. So tactically, you brought up the point that there's a lot of stocks out there that have just been absolutely decimated. Some of the most well-known companies that are stalwarts of the U.S. economy that aren't going anywhere. In fact, that are still profitable to a great extent and have tons of cash on the balance sheet and probably not really affected by this economic downturn whatsoever, but yet people want to sell us these stocks for a low price. And we're not going to take that price because we know they're worth more than that. So by taking advantage of the opportunity, converting a position, that's something that I think our listeners need to know. You don't have to convert an entire account. We can convert a single position, a single stock from traditional to Roth, get those dollars into your Roth account that are discounted, which means we pay a discounted tax as well. And then any of the gain that we see in that growth of the stock and that rebound of the stock price is captured in a Roth, which is tax-free. So that's the difference between long-term and then tactically we're thinking shorter term, maybe smaller movements.
I know, Chaz, you and I worked with a client. She had recently lost her husband and was put in a situation where she needed to purchase health insurance, right? So we were looking at, and she's under 65, so she was on the marketplace trying to buy health insurance. And one of the things we wanted to do is to keep from having that insurance premium on the marketplace skyrocket. You and I worked together with her and said, okay, you've got some funds already in a position that's tax-free right now. You've got some Roth money. Let's supplement some of that income because that is not reportable when it comes to figuring out what your health premiums are going to be and her premium tax credit. So we were able to work together with that, saved her a great deal of money on her monthly health insurance premiums, and really didn't impact her portfolio at all moving forward long term. Yeah. So, that's another reason why not only, are we buying it, with tax rates as low as they are right now, but that's another reason why is to utilize some of those non-reportable incomes to help offset some insurance premiums.
Well, definitely, it points out the importance of the team approach as far as looking at the financial decisions impact the healthcare decisions, the cost, which impact your taxes. And, keep in mind that we're not CPAs. You always want to seek the advice of a qualified accountant or tax professional before you make these changes and know what your tax situation is. But, again, thinking in that context of looking at a total game plan, we recently met with some clients. This is another strategy for, looking at tax savings opportunities for 2023. David and Kay, and, going through their plan, looking at their situation, they had a solid financial plan put in place. Like financially, they did a great job. Again, they built up this phenomenal tax-deferred retirement account. And so the question becomes, what could blow it up? Sure. And, what could blow it up would be higher taxes because they'll have to pay more because it's tax-deferred money. Now, in addition to that, if they don't spend all this money and leave it to the kids, that's where this tax time bomb can go off. And the tax time bomb being the fact that the kids, haven't paid the taxes on it. So if they take that money out, and one of the strategy number 3 is to pay some taxes now to put a shield over top of your assets to protect you from a healthcare crisis, and also to build a tax-free bucket of money for your beneficiaries. And so what we did is we took some of the money that they weren't going to use, systematically started to move it out of the retirement account over the next 10 years, paying taxes over a 10-year time frame. By doing that, able to get Kay a $350,000 shield over top. So if she has a healthcare crisis sometime during her lifetime, she could go into that bucket versus spend her investable assets. And then if she didn't do it because it's life insurance, if she names her beneficiaries correctly, it's probate-free, income tax-free cash versus the tax-deferred retirement account wouldn't do that. So the next thing is looking at your asset location. It matters. Long-term versus short-term capital gains. Your more active strategies might be better in your retirement accounts than your non-taxable retirement accounts. And when number 5, when you're looking at your non-taxable accounts, you want to consider things like the higher interest rates that are out there now. And that's where things like municipal bonds, which are also trading at what I believe to be an attractive discount, could be another opportunity to generate more income, but to also generate more tax-favorable income. At the end of the year, you've got to look at tax loss and tax gain harvesting. And then finally, if you're over 70 and a half, consider using your retirement accounts to make charitable contributions. So lots of great things to think about when you're thinking about taxes this year and you're thinking about retirement tax strategies for 2023. And how this all comes together for you is to call us. What we can do is take that information and put it together and create a 2023 tax roadmap for you. We'll go through these items, go through the checklist, and see which of these apply to your situations and how we can either help introduce you to an accountant or work with your accountant to make sure we cross the T's and dot the I's to not just make decisions about recording the history, but how do we keep the government away from your money in the future.
Here we are in the middle of March. We're about a month away or so from our 2022 taxes being due. And so many of us are focused on that and looking at ways to be clever about how we can save on what we owe from the previous year, looking in the rearview mirror. What we're talking about here is looking forward, not just for 2023, but the 20, 30 years you're going to spend in retirement and how to minimize the tax effects there. That is where this tax roadmap really comes into play. And it's something that the team at America's Retirement Headquarters can help you with. All you need to do to get started and create a tax-savvy retirement strategy, 419-794-3030 is the phone number. Once again, 419-794-3030, or go to the website, arhq.com.